Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today we're going to be taking a look at Salesforce stock, ticker CRM. I had multiple requests to do an update video on this one after you can see about 20% drop in the stock price after earnings a couple days ago. So I actually do have another video out on Salesforce that I put out in November. Let's see. It was actually right at the same price basically that it's at now, which is kind of funny, but everything I was looking at then, I went and just looked at part of the video to kind of see what I was saying back then. The big difference now is we actually do know what these earnings for 2024 came in at, and they exceeded expectations. So a little bit more good news priced in to the stock, at least in terms of last year. And so now it's kind of interesting to see the stock price fall. So as always, this is not individual investing advice. This is just how I analyze stocks. I also have, if you have a request you'd like me to take a look at, like the folks that requested this one, just put it down in the comments section. If it's a stock that's in the S&P 500, I post those on YouTube for free. The rest I post over on Patreon, which is $5 a month. And then if you join there at the $5 level, you can get a big discount if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha. And if you don't want to do Patreon, I have a direct link to the Seeking Alpha investing group down in the description as well as a 25% off affiliate link for Fast Graphs, which you'll see me use here in the video. All right, so let's take a look. So Salesforce, great track record. That's all good. Really, it's all been about whether we can buy it at a good valuation. So it's traditionally traded. Actually, let's just put it is traditionally traded at a 99 PE ratio, which is kind of nuts. What was it back? I guess it's too small for me to see it. So yeah, but I'm not expecting it to trade back at a 99 PE ratio. So that's why I'm not using that kind of mean reversion assumption. We almost bought this one. We were so close. It was really teetering right when it was down here at the bottom. I think I was waiting for the momentum to get positive, and then by the time it did, the stock price kind of took off and didn't really look back. So, but I was definitely interested down here. But at the time, I didn't expect them to grow earnings 57% in 2024. That was a pretty big surprise. The trend certainly you have a COVID bump here, but in the 3 years surrounding it, the trend was like high single digits maybe earnings growth. So, and I think that's what they're forecasting now, like 8%. I think they were talking revenue growth. So it gets pretty tricky because my standard analysis will look at the historical kind of earnings growth and kind of use some common sense in there, but also extrapolate that out into the future with a 20% maximum. So for a long time, I had a 20% maximum earnings growth assumption, and then I was just looking for a valuation that looked good. I think after these couple years, I lowered that to a 15% earnings growth assumption. And in this analysis, and that's what I used in the last video in November, in this analysis, I'm going to bring it down to like a 12% earnings growth assumption just to be a little bit more conservative. But because I don't think we pretty much know they're not growing at 20% for the next 10 years. I mean, they wouldn't even say that. The revenue growth is only going to be, they're thinking this year, like 8%, right? So the odds of them growing earnings, 20% for the next decade are pretty low unless revenue growth actually picks up as well. So I think the 12% is pretty generous, pretty fair, but they have shown that they can come in and like beat earnings because we were not expecting back in, let's put it this way, what was it, the end of 2022? We were not expecting, would have actually been 2023 where they grew earnings 57%. I don't think hardly anybody was like expecting that. So that 12% just seems reasonable to me. I mean, a person kind of just has to, Wall Street right now is looking at 15%. So that's a little bit of a margin of safety compared to what the market is pricing in. even though the stock fell 20% because of the revenue guidance, earnings still expected to come in exactly where it was expected to come in before. So earnings haven't, earnings expectations this year haven't really come down yet. Even though we got a big move in the stock price. But I mean, look, it was at a 40 almost PE, right? So that's, if you're at a 40 PE, you need to be growing 20% or more, right, to justify it. So if you're only going to grow 15, 25 just on the surface looks like fair value, right? And we'll see in just a second here. But it's a little tricky because you really just have to kind of ask yourself. One of the things that I ask myself is, look, they're a $200 billion company right now. How big can they really grow over the next decade, realistically? Do we really think that they could, be over $1 trillion, $2 trillion company in 10 years from now? Well, it's possible, but what's realistic? What can, maybe I'm thinking the 750 billion would be if we get some inflation, if different businesses grow and they can grow as well. But it's hard to think that they're going to grow 20%, and get up into the trillions and trillions of dollars of market cap because they're already so big. So when I have big businesses, I tend to be more conservative on those future earnings growth rates. Now, if it was a smaller business that had a bigger addressable market, I might be willing to assume that they can grow 20% for the next 10 years. So 12%, that's a long way of saying I'm using 12% earnings growth expectation when I run the numbers. So, and let's see, on Fast Graphs the PE is 25. So I already showed you that. I'll see what mine is. My PE using forward earnings is 20, closer to 23. Okay. So let's see if I adjusted for, debt looks fine. I didn't make any adjustments really for that. So a little under a 23 PE with a 12% earnings growth rate assumption. So when I run the numbers on this, I convert the PE to a earnings yield. So that's instead of price over earnings, you put earnings over price, and that gives you a 4.4% earnings yield. So the way I like to think about that is, if I bought the whole business for $100, I would earn $4.40 on my $100 the first year, and then I assume that will grow at 12% each year and compound. So I pull the first years forward, so I assume my $100 would earn me $4.93, and then I want to see what it would grow into after 10 years with those assumptions. And my $100 would earn me an additional $86.50. And then I convert that to a CAGR. You can just put that in a CAGR calculator or a spreadsheet like this one. So if they grow from here at 12% a year, and they earn the $9.73 they expected to earn this year, that would be a 10-year business owner's CAGR, earnings CAGR of 6.43%. That is right in the middle of fair value. I think last time I did this analysis, it was right in the middle of fair value at this price as well. So not too much has changed, except for I lowered my earnings growth rate by 3 percentage points. And it's about at the same price that it was in November. So they had that big spike up of optimism, and then it basically came back down. And now it looks, with these assumptions, about fair value. So when to buy? This is going to be a little different. Last time I think my recession buy price was quite lower, and here's why. This might be pretty close to being, I don't know if I adjusted this for the 12% or not. I think I did. So just using this standard analysis, $165 a share would raise this 10-year earnings CAGR up to 8% if everything else stayed the same and only the price fell. So that would be just kind of a basic buy price. That's about 25% lower. But if we do a recession, this is where it gets a little bit strange sometimes for some folks, because if we use the recession approach, the recession PE approach, the buy price is actually higher at 192. And this was down in the 120s, I think, in November. It was much lower, and here's why. So we didn't know if they were going to earn, I did this analysis somewhere in, November? Yeah. Probably right in here. And we didn't know what they were actually going to earn in their fiscal 2024. There was still a couple months left before they reported. And so I actually used this 2023 earnings as peak earnings because I wasn't sure what earnings were actually going to come in for them. And that gave a much more conservative recession PE because I assumed this would be the peak, but now the peak is actually 57% higher than that. And that's what's raised this recession buy price. So what the recession PE does is it takes the price and it compares it to this $8.22 because it will assume kind of basically that these earnings either this year or next year will make new lows. Like there'll be some kind of recession, or even if it's an industry specific recession or whatever. Sometimes it's just company specific. But the idea is you're assuming that whatever earnings decline off this peak happens, that they'll be able to bring them back within like a year or two and resume previous growth trend. So what it does is it creates like a stable point, at least annually. So last year that point was $5.24, and now it jumped a lot to $8.22. And what I did was I took this price decline and compared it to the previous peak earnings, which were $4.92, and that's where I got that recession PE from, which was like 23-ish, right? I think. Let me double check that. Yeah. So in order to get that again, we need the price to get a similar PE again, the price would need to fall to 192 based on these higher earnings. Now it looks a little different because it looks like the current PE is lower than the recession PE, so it should be a buy now. But the current PE is based on forward earnings and not last year's peak earnings, because we don't know if these are actually going to come in higher than 822 when it's all said and done. They could disappoint and it could fall. That's what the recession PE is trying to protect against. Because what will happen is if that $9.73 comes down, this normal buy price here will go down as well, even if I just kept the 12%, because the starting yield, that 4.4%, will go down if earnings go down, right? So this could keep getting, worse and worse, which is, it's already worse than the recession PE, but it could get even lower. So it's a little strange when you look at it. But right now, it's really because they had such a big spike in earnings last year relative to kind of history. That 192 spot would be where I would consider buying. Now, here's the catch. When you have like a growth business like this that's big, that's already grown a lot, where earnings are probably going to be difficult to grow fast into the future, and it's in a downtrend, not only would I want that recession PE to be met, but it's not really something I would want to be buying on the way down, because there can be a lot of multiple compression, and even especially if earnings are lower in the next year or two. So instead, which we've already seen earnings multiple compression. It was a 63 PE here. Now it's a 25, right? And investors are down like 30% or something. So what I want is I also want momentum to be positive. And so I pull this off. Seeking Alpha has a momentum score if you join their premium service. So it's just slightly negative now. C plus would be 0 and then a B minus. So there's like 2 grades after this down price drop below positive, which would be like a B minus or a +1. So it's a little bit below that. So really what would need to happen is the price would need to come down below 192, kind of bottom down there somewhere, and then start to come back enough to get that momentum building again. And that's when I would come in with a stock like this, because that multiple can keep compressing. It can keep going lower, but we don't have a history to rely on other than this little mini downturn, which wasn't even a recession, right? So it fell to like 23 or something, 24. Maybe if you picked the day, it would be like here. But it hasn't, the lowest PE it got in 2008 was 90, right? So you can't really go back in time and apply that once earnings growth starts to slow down and once their addressable market starts to be filled more, unless they have some kind of other growth driver like come along. But I'm not sure. Maybe AI will be it. I don't know. Maybe that will just be more competition. That's really hard to sort out. So basically, what I want is a dip, and this is what probably why I ended up missing this in late 22, because I want to say it was almost right at my buy price, but I wanted the momentum to be positive as well. And then by the time the momentum was positive, the price had gotten a little bit too high because we hadn't really seen these earnings bump yet. It didn't. I mean, for 3 years in a row, they didn't really have, a whole, or 2 years in a row anyway, they didn't really have a whole lot in the way of earnings going on. So sometimes sometimes you get them and sometimes you don't. When it's a high PE stock, I am willing to usually be patient, especially if it's already big. So, and sometimes depending on the point in time you pick, like I made my last video, I think around here or so, and I think my buy price was down under 130, and then it rose 40% in like 4 months, right? So you can't really predict exactly what's going to happen, but basically we're just back to where we were 7 months ago. So, hopefully this just frames things for people a little bit, gives a couple different ways to look at. This is one that's just not very, it requires a lot more judgment than, what did I do the other day? ADP, that one doesn't require very much judgment. It's pretty straightforward and simple. Stocks like this that could be going through a multiple compression cycle where earnings could be growing but still pretty strong, where we're not in a recession yet but we could be, where there's different types of competition and technology that maybe will help them but could also hurt them. You have all these different things that kind of come into play, and I don't think there's a way to like easily sort out all those. At least I don't try to do it because I cover a lot of stocks, but I do think you can put like a reasonable number, and then if the stock gets cheap enough, you can say, all right, I don't know what's going to happen, but I'll take my chance here. And so I almost did that down here. Maybe we'll get another chance, and we'll see. If you found this useful, hit the subscribe button, hit the like button. If you have a request, put it down in the comments. I'll see everybody later. Bye.